Welcome to the 19th episode of Dividend Investing Insights, your one stop for all things dividend investing. Join us as we explore high yield shares, dividend growth strategies, and portfolio management techniques to maximize your investment returns. Subscribe now and take care of your financial future with the power of dividends. In the episode today, we will continue to look at the portfolio that we have built and see as to how it performed in the last 1 week. However, like always, we will start with the performance of the markets in the last 1 week. S&P 500 went up by 88 points to end at 6,032 points. Nasdaq too went up by 251 points to end at 19,218 points. And here locally in Australia, ASX 200 went up by 42 points to end at 8,436.2 points. Anyway, as I have said, markets will go up and down all the time. Share prices will go up and down all the time. However, you as an investor should invest in fundamentally strong companies that have the ability to pay dividends now and increase their dividends in the future. With that said, let's do a quick recap of the portfolio that we have built. The first stock that we had built when we started building this portfolio was Keurig Dr. Pepper. We bought 50 shares at 37.46. We then bought JP Morgan Chase. We bought 10 shares at $210.5. Then we bought AT&T. We bought 100 shares at 21.91. We then bought CVS Health, 30 shares for $60.3. And lastly, we bought Unilever PLC, 33 shares at 61.32 for a total investment of $10,002.76. Now, while we have been tracking on a week-to-week basis, before we look at the current price, let's look at some of the salient features of this portfolio. Now, first and foremost, this is a diversified portfolio. We've got beverages, we've got bank, we've got telecom, we have healthcare, we've got FMCG. What that means is that if one of the industries is not performing well, the others will cover it up. So whenever you make a portfolio, make a diversified portfolio. Secondly, most importantly, the company should be fundamentally strong. We have looked at financials of all these companies. We have looked at their recent performance. We have looked at their payout ratios as part of the dividend checklist, dividend investing checklist, and these are fundamentally strong companies. Another very important factor, as we have gone through some kind of market instability, some fears of recession, all these companies, all these industries are low recession. They have low impact of a non-recession. In a situation of recession, people will still go to the banks, people will still use telecom, people will still have some kind of beverages, they will still have to take care of healthcare, they will still have to use some of the products that these companies make. So this portfolio, low recession impact. And last and not the least, we had kind of taken a strategy that, we selected stocks at the time of buying that there was some kind of a short-term benefit with some immediate dividend that was being paid out. So not an absolutely mandatory criteria, but something good to have, which we had adopted. Now let's look at how these are faring since the time we have bought. So as of this recording, Keurig Dr. Pepper is trading at 32.65 for a portfolio value of 1,632. So while KDP has gone down, JP Morgan Chase has gone up significantly and is currently trading at 249.72. AT&T has also gone up since the time we bought, and it is currently trading at 23.16. CVS Health is more or less at the same price, trading at 59.85. And Unilever PLC, again, more or less flat since the time we have bought for at 59.84. Which gives us a total portfolio value of 10,215. While this is higher than our investment of $10,002, however, that's not all. We've got dividends from all these companies, and the dividend that is available with us in cash is $71.7, which at some time we will reinvest, which gives us a total portfolio value of 10,287.62. Now, while this is a short time and we are already making profits close to $280, this is not a time that we rejoice or we feel very excited about. You will see how progressively, using a standard dividend investing approach, your investment can be secured and you will see progressively growing it. Now, let's put us in a graph and see as to how it is performing. Now, if you look at it, roughly 3rd November, when our portfolio was ready, our investment amount portfolio value was something like 9,870, which has now steadily grown to 10,287, which is an increase of pure increase of 285 annualized comes to 24%. But we won't go into the details. We'll continue to monitor it and see as to how this grows. And you will see that the blue line will be far off from the orange line, which is what our investment of the portfolio value is. Well, as we come towards the end of the episode, let's first look at as to what dividends are coming our way. So the upcoming dividends that we have is Unilever PLC. Unilever PLC will be paying a dividend of 47.55 cents per share on 6th of December, which is next week. So next week we'll claim this dividend. What is also important is that the number of companies are announcing their declaration dates. So all, as per statutory requirement of all stock exchanges around the world, any publicly listed company needs to declare their quarterly results. And all our companies are responding, coming back with their results. CVS Health is coming on 3rd December, KDP is coming on 5th of December, JP Morgan is coming on 10th of December, AT&T is coming on 11th of December. I'll share some kind of a snippet as to what these companies have said at the quarterly hearing, and what do the CFOs, what do the CEOs says is what I'll share with you. And that would give us an indication whether KDP or CVS or JP Morgan is going in the right direction, or AT&T is going in the right direction. They will also announce the ex-dividend date for the next dividend and the payout ratio, so that we can track as to what dividends are coming our way. Well, that's towards the end of the episode. And like always, putting up the dividend investing checklist again. Use this checklist for all your investments. Quickly going through the checklist. Do you understand the company's business? If yes, do think about investing in this company. What is the dividend for the current year and the dividend yield for the current year? What is the average dividend for the past 5 years, so that you could do a comparison? Has the dividend been going up, or has the dividend been flat, or is the dividend going down? If the dividend is going down in comparison to the previous 5 years, no need to make an investment, drop the company. What is the payout ratio for the stock? Is it between the 30 to 70% range? If it is more than 70%, don't do it. Don't make an investment. On the other scale, 30%, less than 30% may be good, but generally it's considered 30% to 70% a good payout ratio. What is the price to earnings ratio? Again, depending on the industry, anything between 1 and 20 is considered good. More than 20 needs more investigation. What is the price to book ratio? Ideally closer to 1, but anything between 1 to 3 is considered good. Does the company have year-on-year revenue growth? Does the company have year-on-year profit growth? Does the company have positive cash flow? Use this checklist to make your investments, make wise decisions. And that's the end of the episode today. So until the next episode, thanks for watching, and see you in the next episode.